Hi, I'm Campbell Harvey, professor of finance at Duke University. My research is in investment and risk management, and we've had a risk realization, and that's what I want to talk about today. My topic is there light at the end of the tunnel? We're in a crisis that is very unusual. Some people call it a black swan event, and they're wrong. This is not a black swan. A black swan is something that you really haven't seen before and just incredibly rare. Pandemics are not that rare. So we've had major pandemics throughout history. Indeed, we had a massive pandemic in 1918. We've had numerous other scares. So SARS in 2003, we had MERS, Ebola, HIV. This is not a black swan. So the main question that I get all the time is, will this very sharp downturn lead to a lost decade? And that means that we will take a very long time to recover from this particular negative economic episode, as well as the health episode. So there's a paper that's floating around by the San Francisco Fed. And it's an interesting paper because what it does is that it looks at many pandemics historically. Indeed, it goes all the way back to the Black Plague. And the empirical analysis in the paper suggests that there's a period of prolonged slow growth after a pandemic. So this is consistent with a possible lost decade as a result of this episode that we're experiencing today. Let me argue that this time is different. So in 1918, the world was hit by the Spanish flu, and people didn't really understand what it was. It hit in the spring, it went down in the summer, and then it came back in the fall. And indeed, more people were killed in the fall than in the spring. And if we population adjust, the number of people that died from the Spanish flu was 200 million people in today's population terms. Okay, so this is very significant, but what's important is the following. In 1919, people were uncertain as to whether it would return. It wasn't clear that it was resolved. Indeed, it came back in the fall of 1918. So fast forward 101 years, COVID-19 is the latest pandemic. After COVID-19 is identified, in 2 weeks, we came up with a complete DNA mapping of the virus, and people began to work on a vaccine. We know exactly what this virus is. There are many teams working on vaccines, and it's only a matter of time. With more than 99% probability, we will have a vaccine within like 12 to 14 months. So this is the difference. The difference is that in previous pandemics, especially the Spanish flu, there was no indication of when this would actually end. Whereas this particular economic episode, we can see the end. This recession is triggered by a biological event. And the end of this recession will also be triggered by a biological event. So there is light at the end of the tunnel. Let me actually draw another analogy in terms of this uncertainty. In the global financial crisis, which is the most recent recession, indeed called the Great Recession. The reason it's called the Great Recession was there was a lot of speculation during this recession that it was going to be a depression. It went on and on and on. Indeed, it officially ended in September 2009, but we didn't know it had ended. So the end was determined well after the end. Indeed, unemployment continued to go up and peaked in 2010. So people didn't really know it was over. And when people don't know it's over, it changes their behavior. So consumers, they're not sure if they've got another 3 or 4 years of this. So they're very conservative in their spending. Corporations, the same thing. So why make a major capital investment or hire a number of people when it's not clear that the recession is actually over? So we saw a period of prolonged slow growth after the end, the official end of the global financial crisis. This is the uncertainty aspect. So what's different with this one is that the uncertainty will be resolved. So in the second quarter and third quarter, it will be ugly, and people expect that. The economy has suffered a sudden stop. But by the fourth quarter, we'll have some pharmacological solutions to mitigate the effects, and things will turn around. In the first quarter, at some point, I fully expect a biological solution, so in form of a vaccine. So the key thing is to minimize the damage to the economy, because it's possible that we can have not just a sudden stop, but a sudden start. So the second question that I get a lot is exactly having to do with minimizing the damage. So let me talk about that. So this recession is different because it focuses on a different group of companies. In the global financial crisis, that was a crisis that was caused by financial events. So our banking sector, many of the banks did a very poor job of risk management. They had extreme leverage. And when a small event happened, that affected them in a very large way, putting our entire financial sector at risk. So this was a large corporation problem. Indeed, you could imagine putting the 25 CEOs of the largest financial institutions in one room and the Treasury going in and handing them checks and substantially mitigating that crisis as a result of those bailout checks. So bailouts, and bailout is the right word. They were controversial in 2008. Why should we bail out a firm that's done a very poor job? And indeed, if you bail out a firm that has gone offside, then there's no reason that they won't do this in the future again. And that's called the moral hazard problem. Okay, so what about this particular crisis? Well, it is different. So we can't point our fingers at any particular sector saying, oh, it's your fault. No. And is this a banking problem? No. So after the global financial crisis, those banks were prohibited from acting like hedge funds, and they were subject to stringent stress tests. So the banks actually going into this particular episode are in much stronger shape than the global financial crisis. This is a crisis of small and medium-sized businesses. And there are 30.2 million small and medium-sized businesses. So we can't put them in a room and hand out checks. So logistically, this is way more complex, way more complex. And this is also crucial. In the global financial crisis, we are bailing out firms that were, many of them had done a poor job. In this crisis, we are giving aid to many firms, many more firms, many high quality small businesses that were doing well, but they need aid. And the key is to minimize the damage. And what I mean by that is if we lose even 10% of these small businesses, that's like 3 million businesses, that will delay the recovery. So think about it another way. And this is kind of the psychology of this particular crisis. In 2008, when Lehman Brothers went down and you were laid off, you didn't expect to go back to work at Lehman Brothers because that firm was gone. And on top of that, to get a job at like another firm was going to be very difficult because many of these firms were severely downsizing. Some were being acquired and downsized and rationalized. So it was extremely stressful. So today, we've got record surge in unemployment. But instead of using the word layoff or lose your job, it's a different word. It's furlough. Okay, and that's really important because if you're furloughed from a high quality firm, then you actually expect to go back to work. And that's a reasonable expectation. So that's what I mean by minimizing the damage. Some of these firms will be effectively in stasis. They will reawaken and then ideally call back their employees. Okay, so given this expectation that people will be called back, I actually think that even though we've seen a record surge in unemployment, that we will see a record decrease in unemployment once we're through this biological crisis. So obviously our policymakers understand that there are differences between this particular recession and the global financial crisis. So many initiatives have been put forward to support small businesses. So the CARES Act allocated $350 billion to support small businesses, and the signature program, the PPP, which is the payroll protection program. So it is one thing for Congress to approve $350 billion, but another thing to actually deploy the $350 billion. And that's really important because we've seen the economy collapse at a speed that historically is unprecedented. And many of these small businesses, they need the loans now. And what I worry about is excessive red tape that is causing a delay in the deployment of these loans. So any delay will mean that more of these firms will go out of business permanently. And that is a negative for the strength of our recovery, the time to which we recover also. And let me make another point. So many of these businesses, almost all of these businesses, we're not familiar with. We know the names of the big corporations. But many of these businesses are integral for our global supply chains. So you might go shop at Walmart, but you don't realize how many of these smaller firms are integral in getting the product on the shelf. These supply chains are crucial for the functioning of our economy. Yet, if a lot of these small and medium-sized businesses go down, that will complicate the efficiency of these supply chains. It will complicate the recovery time. So this is another reason that we need to focus on the small and medium-sized businesses. So 350 billion sounds like a lot. I don't think it's enough. And I think that this is the sort of crisis that you need to hit hard and quickly. So I can understand policymakers being hesitant in kind of the usual recession. So for example, in the global financial crisis, they probably wanted to hold back some dry powder because the policymakers had no idea how long the crisis would last. Again, this is completely different. With a biological solution, when we have vaccine, it is effectively an all clear. We know the horizon for getting the vaccine. So the policymakers can hit this hard to basically preserve high quality firms. We lose high quality small firms, then that will be a drag on growth in the future. So I talked about this San Francisco Fed study and the slow growth after pandemics. Well, I argued that this slow growth was in part caused by uncertainty. Well, in this particular episode, we have the resolution of uncertainty. So the slow growth will not come from consumers or corporations holding back on their spending. The slow growth will be potentially self-induced by policymakers creating so much red tape that we don't get the loans fast enough and these firms go under. Of course, these firms or other firms might reappear. If it's a good business, then it could be recreated. But to recreate the business involves a lot of cost and it's completely wasted. So speed is of the essence. So let me get to some questions that have been asked. And let me kind of go through them one by one. This is a question from Matt, who is an alumnus, and he writes, can you be specific about the nightmare stories in terms of red tape? Okay, let me try to address that. So many people are reaching out to me with stories about their experience with the facility that is sponsored by the Treasury and the Small Business Administration, and again, under the CARES Act, 350 billion, to be precise, 349 billion is allocated towards this program. So the sort of things that I've heard are pretty disturbing. So things like this is administered by banks, but it's administered in different ways across different banks. So the sort of information that's required for one bank, it's different for another bank. And a business is often dealing with more than one bank. So even basic things like the number of employees you have could be counted differently with one bank than another bank. So there's no consistency in terms of the application. You apply, you go through the online system, and I've heard that there's no acknowledgement of the application. I've heard people writing to me saying that there's no way to update the application once it's submitted. People have told me that you have to do the application in one sitting. So you can't save your work and collect some further information and get back to the system. The level of detail in terms of the questions seems excessive. A number of people have written to me saying, quote, "It makes no sense whatsoever," unquote. And then perhaps the two most disturbing things. Number one, the banks are inundated. So again, there are 30.2 million small businesses. So there's just like a massive drag on their capacity. So the message to the applicant is, we have no idea how long this is going to take to process. There's no timeline. So there's no interpretation. So again, this is urgent, yet no timeline is actually offered. And of course, a number of people wrote me saying they did the application, submitted, and then the system crashed. So that just tells you the number of applications that are going on simultaneously. Nobody really expected this, but all of these sort of feedbacks that I've got suggest that there are issues. So in my opinion, this is an extraordinary crisis, and the speed of this crisis is very substantial. So we need to make some trade-offs. And one trade-off is to make this application simple. Yes, it's true that some people will take advantage of it. There are some small businesses that will apply for a loan that they don't need. And some small businesses, and this will be, in my opinion, a very small minority, will take those funds and not use them the way that they're supposed to use them. They'll line their pockets. That's a cost. And we can mitigate that cost by having additional due diligence. So we can reduce that. But that additional due diligence also comes at a cost. And that's what I mean by a trade-off. So the additional due diligence, number one, the banks are completely overwhelmed. That additional due diligence will take time. And with that time, businesses will fail. People will be permanently unemployed rather than furloughed. Supply chains will be damaged. The strength of the recovery will weaken. The time to recovery will expand. That comes at a cost also. In my opinion, the cost of delaying a recovery far outweighs the cost of a few people abusing the system. So this is a very important trade-off. And this is what keeps me up at night. Because this scenario of a robust recovery is crucially dependent upon getting lifelines to small and medium-sized businesses. So these stories that are coming in, I'm sure there are many more. I certainly hope that our policymakers understand the difference between approving $350 billion and deploying the 350 as quickly as possible. Okay, so I've got a question from Mitchell, who is an alumnus, and it's about the recovery, what letter of the alphabet? So we like to simplify recoveries and assign a letter of the alphabet. And Mitchell actually suggests a V, a U, an L, or a W. So let me talk about each of those. So the V is an immediate snapback. It's the ideal situation where you have a 1 quarter of really bad growth, and then you snap back and you end up where you were very quickly. The probability of that is close to 0. So the second quarter is going to be ugly. The third quarter is also going to be ugly. So can we have some recovery in the fourth quarter? Yes. So the next letter is a U. So a U is a prolonged period of very slow or negative growth and then a recovery. So I actually don't think that that is an accurate representation either. So basically, as I've said earlier, this crisis has a biological resolution. So I don't see a long period of negative or low growth. I see a shorter period. It's not a V, but it's not a U either. So the third choice is the L, the dreaded L. And that's what I talked about earlier in terms of a lost decade. It's basically the GDP goes down and stays down. We have almost no growth or negative growth over an extended period of time. So again, that sort of situation could be self-induced by policy blunders, but it's certainly not going to be induced by the biology of this particular crisis. So there is a biological resolution, and the question is, will our policymakers do enough right things? I don't expect that every single thing that policymakers do will be ex post the right thing to do. But there are things that are crucial to do to keep high quality firms in business. It's not their fault that we got hit by a natural disaster. So think of this as a hurricane hitting and a government helping with bridge loans firms to recover. Okay, so that I think is very important. So the W, I don't think is credible either. The last W we had was in the early 1980s, the so-called double dip, where we come out of recession and then go back in. Technically speaking, there was another W, and that was the Great Depression, where we had a very long period in the early 1930s of very slow or negative growth. And then we snapped out of it, but then went right back in. So people generally think that most of the 1930s was the Great Depression, and it actually puts together two very serious recessions. I don't think that it's a W. So I actually think that it's not a letter that is one of the four that Mitchell suggests. I characterize this as a skinny U. So it's not a V, it's not a U, but it's a skinny U. Indeed, you can think of it as a test tube shape. Given the biology of this crisis, maybe that isn't a symbol that makes sense. So again, what I see is the second quarter and third quarter being brutal in a way that we've not seen before. Indeed, the unemployment rate could go to 25%. And we haven't seen that since the Great Depression. But again, don't be misled by that. So just because we have 20+% unemployment, that doesn't mean that we're in a Great Depression. And the reason is that many of these people believe that they will go back to work as soon as the biological aspect is over. And that's crucial. If you're out of work in the Great Depression, there's almost no opportunity for years, for almost a decade, there's no opportunity. Very, very, very challenging. Whereas this is more of a temporary episode, transitory. And I think that's fundamental. And it's a big mistake. Say, well, we've got a level of unemployment like the Great Depression, therefore we're in another Great Depression, a 21st century Great Depression. No, I believe that that is faulty reasoning. So again, the jobs could be available at a very quick rate once the biological issues are actually solved. So this is not like the Great Depression. This is not like the Great Recession or the global financial crisis. This one is different because of the cause. Okay, I've got a question from a third alum, Rodrigo. This is a really good question, that the stress on the small businesses does it potentially lead to a financial crisis amongst the banking sector? And this is a great question because think of the scenario where small businesses are given loans by banks. The loans become non-performing, and then it puts these banks at risk and creates another layer of crisis. So let me address this question. And I actually think that our policymakers are doing a number of things to mitigate this possibility. So number one, the banks are actually in a much stronger position today than they were in the global financial crisis. So it's a much stronger position because their leverage is less, their capital reserves are more robust. They've been essentially out of the business of hedge fund-like investing for many years, given legislation in Congress. And they've been subjected every year to stress tests. Okay, so looking at scenarios, maybe not as bad as what we're experiencing, but pretty severe scenarios to make sure that they actually survive. They need to have the capital to survive. So number one, the banks are in a much stronger position. Number two, our policymakers have taken a number of initiatives. So the Federal Reserve in particular wanted to avoid the following problem. And this was a problem in the global financial crisis in particular, where large corporations were pinched for cash. They had to go and extend their credit lines. They did that at the banks, and the large corporations got the credit, but there was nothing left over for the small and medium-sized businesses. Okay, so that would be a huge mistake if it happened in this particular crisis. So what have our policymakers done? They provided mechanisms so that these large corporations can access capital in different ways. So for example, one of the first things that the Fed did was to create a special purpose vehicle that would purchase commercial paper. So commercial paper is short-term financing, and many large corporations actually use that. And it's offered on our capital markets. It's not from a bank. Okay, so in doing this, it provided support for that market. And that means that the large corporations could go to the commercial paper market to get short-term financing rather than going to a bank. So the Fed has also established a number of other facilities. So there is a facility that purchases corporate debt, both, there's two of them actually, one for the primary market, so the initial offering of corporate debt, and then there is one for the secondary market also to support the secondary market. Again, this allows these large corporations to go to the capital markets to receive financing rather than tapping the banks. So there's even additional things that the Fed has done with the same basic idea. So this idea of the Main Street lending facility, essentially what that is something that's directed at small businesses. So the banks are administering the $350 billion. And what's possible is for the banks to basically sell those loans to a special purpose vehicle set up by the Federal Reserve. Okay, so the beauty of this idea is that it actually takes the risk off from the bank, and the banks actually retain 5% of the risk, and it puts it on the Fed, and the Fed is backstopped by the Treasury. So there's money that's been allocated to this by the Treasury. And it also allows the banks to actually do more of this lending without putting the bank at risk. Okay, so this again is a different scenario than the last time. Indeed, some of these vehicles that were set up by the Fed, they had experience with because they were ongoing during the global financial crisis. So they set up a number of these, like the so-called TALF, which goes and purchases student loans, autos, credit card debt. They had that during the financial crisis. So they just basically reposted the term sheet. So again, a number of these initiatives are to support the capital markets so that large corporations can actually go to the capital markets rather than tapping their bank and then drawing down the bank's capital so that the bank doesn't have the capital to support lending to small and medium-sized businesses. Okay, the last question has to do, and kind of is a good segue in terms of the Fed actions and what we can expect in the future from the Fed. So what we can expect in the future from the Fed is essentially additional support. However, the Fed is technically prohibited from lending directly to businesses and municipalities. The Federal Reserve Act is very clear that the Fed can buy treasuries and agencies. But during the global financial crisis, the Fed found a way to support other markets. So they set up special purpose vehicles. And these vehicles were designed to buy other types of debt. So the Fed can't lose any money. So somebody needs to be the equity holder. And initially, some of these facilities were set up with $10 billion grants from the Exchange Stabilization Fund of the Treasury. So 10 billion, obviously not enough. And in the CARES Act, there was an additional $450 billion allocated to the Treasury for exactly the purpose of supporting these special purpose vehicles that the Fed has been setting up. So with that 450 billion, the size of the backstop will be very much increased. Indeed, 450 billion, according to my calculations, could support up to $2 trillion in activity. Okay, so this is a very significant innovation. I've got to admit that early on in the crisis, I was worried about the Fed. And I was worried because they took some actions that seemed to be right out of the 2008 and 2007 playbook. And it worried me a lot. So for example, they cut interest rates from 1.5% to 1%. And I didn't think that was necessary. Rates are already low. Then they cut the rate to 0. And I especially don't like that. And again, it seemed odd because during the global financial crisis, the first cut of 50 basis points came when rates were 5.25%. So the rates were actually high. Going into this crisis, the rates are low. Like 1.5% is a low rate historically. And then they started to do some of the special purpose vehicles that we saw already in the global financial crisis. And I'm thinking, are they using the same playbook as the global financial crisis? Because that's a big mistake. Because this crisis is fundamentally different. However, the recent actions of the Fed indicate to me that they're not using the same playbook. They're using some of the tools that they used before, but they fully recognize that this is a different type of support that they need to provide. They need to provide the support to the small and medium-sized businesses. They understand that there are 30.2 million small businesses, and many of them need support. And the Fed is doing what it can. It is being innovative in terms of these special purpose vehicles, and they are trying to support the capital markets. They're trying to support the banks so that we can get these lifelines to these corporations. So I'll end it here. And I'm on LinkedIn, and you can follow me. And indeed, you can send additional questions to me.